Welcome back to the deep dive. Today, we are putting Square, which is, of course, block under the microscope. We're looking at what you can only really describe as a deliberate, very conscious re-acceleration of their entire business strategy.
It's a fascinating pivot. For a long time, the feeling was that Square had been, underestimating its own capabilities.
Right. They built this magnificent platform, but the execution always felt a little timid.
Exactly.
Right.
They had the engine, but they just weren't flooring it. So our mission for this deep dive is to really unpack the levers they pull to finally unlock that speed, and crucially, to figure out if this explosive growth they're projecting for 2025 is genuinely sustainable.
And when we say explosive, we mean a dramatic shift. For the last couple of years, say between 2022 and 2024, their new business growth, they call it net new acquisition, or NBA, was kind of stagnant.
It was hovering around, what, $30 billion?
Yeah, about that. But now look at the projection for 2025. Full-year NBA growth is estimated over 15%.
Which is a huge move. But the real kicker is Q4. For Q4 of 2025, they expect that growth to be over 23%.
That is not a gradual increase. That is a step change.
It's a profound shift in ambition.
So let's unpack what made this possible. What was the old way of doing things that they decided, just wasn't working anymore?
Well, the old setup was successful at a certain level. It was really reliant on telesales.
Which was strong for them.
Very strong, but it wasn't being scaled aggressively enough. And here's the biggest flaw in the old model. They had almost zero field sales presence. They just weren't leaving the office.
It sounds like they were trying to fish for whales with a tiny net.
That's a great way to put it. Their strategy was spread too thin and too widely dispersed.
Trying to be everywhere and nowhere at the same time.
Exactly. So the new approach is the opposite. They identified a few major levers, like their big focus on quick service restaurants or QSR, and they committed to scaling spending and hiring with basically no restrictions as long as they hit a specific ROI threshold.
So no cap on growth as long as the economics make sense.
Precisamente. It's an ROI-driven land grab. They have the confidence in their unit economics to go for it.
And that confidence is exactly what we need to test first.
Yep.
Which brings us right to that big question, the one every analyst asks when a company accelerates this fast. Are they just buying market share with huge discounts? Or is this actually profitable growth?
That is the most important question for you, the listener, and the data here is actually very clear. We need to look at two key metrics. First is new transaction volume, TNV. That's the total dollar amount from new sellers. It's growing at 12% year over year.
Okay, 12% volume growth. So what about the actual profit the money Square actually gets to keep from that?
That's new gross profit, or GP growth, and that is growing at 11% year over year.
So only 1%.
Only 1%. They're almost perfectly correlated. I mean, if they were truly buying market share, you'd see that 12% volume growth, but maybe, 5% or 6% profit growth. The gap would be huge.
Okay, so that 1% difference isn't an alarm bell, but it does suggest something more nuanced is going on. What explains that tiny bit of margin dilution?
There are three main reasons, and none of them are really alarming. The first is actually a sign of strength in the U.S. market. Square notes that in the U.S. specifically, their new gross profit additions are actually stronger than their new volume additions.
Wait, say that again. Their profitability is growing faster than volume in the U.S.?
Yes. Domestically, their unit economics are improving. They actually think there's slack in their ROI model, which means they can probably afford to be even more aggressive in the U.S. and still make great returns.
That's a very good sign. Okay, so what's the second driver?
That would be the international market mix. Over half of their net new acquisition growth is now coming from outside the U.S.
Which is great for scale.
Fantastic for scale, but international markets just have lower margin structures because of things like interchange regulations. So as that international piece grows, it naturally pulls the blended average margin down a tiny bit.
A purposeful trade-off, then.
Exactly. And the third driver is that strategic shift upmarket we talked about. They're trying to move their acquisition ratio from 70% self-onboarding and 30% sales to a 50-50 split.
And the sales teams are going after bigger fish.
Much bigger. Deals starting at $250,000, $500,000 in volume. And those larger sellers, they just command better rates. They have lower margins than the small businesses signing up online.
That makes perfect sense. If you're successfully moving up market, you would absolutely expect to see a slight dip in your blended margin.
So when you put it all together, it's not buying market share. It's smart, targeted growth. They're actually seeing some of the strongest cohort growth curves they've seen in years.
Okay, so the numbers check out. Let's get into the mechanics. What are the four big operational levers driving this strategy for 2025 and beyond? Let's start with their foundation, that self-onboarding channel and marketing machine.
Right, this is kind of the unsung hero of the story. The self-onboarding, or SOB engine, is really seeing a step change in performance. It's hitting some of its highest growth rates since 2017.
And they're pouring fuel on that fire. Marketing spend is up over 50% in the last year.
But it's disciplined spending. They're maintaining a 300% plus ROI with a payback period of just 4 to 5 quarters.
Which is incredibly fast.
Yeah.
That money comes back to fund the next round of growth almost immediately.
It is. And here's where it gets really interesting on the tech side. They're not just buying Google Ads. Their strategy has made Square the #1 brand that appears in SMB-related searches on AI platforms.
That's smart. They're future-proofing the top of their funnel, capturing customers using LLMs to do their research.
Exactly. And beyond search, the onboarding funnel itself is now adaptive. If you sign up as a restaurant, the whole experience is different than if you're, say, a solo professional. It reduces friction, boosts conversion.
Okay, that's the fuel. Lever 2 is about changing their image, right? This perception that they were only for coffee shops and small businesses.
That image was a real ceiling for them. To break through it, they had to go all in on a specific, high-stakes vertical. That's why they declared quick service restaurants QSR as a core focus.
So they're using QSR as a sort of proof point to show every other kind of upmarket business that they can handle complexity.
That's the playbook. QSR is high volume, it's complex, it needs integrations with kitchen displays. If you can win there, you can prove you understand demanding industry needs. And the results are already there. The metric that tracks whether businesses believe Square is built for my business size is up 4.5 points.
And we're seeing the big name wins to back that up. You know, getting Katz's Deli in New York or Bluestone Lane. Those aren't small shops.
No. It totally shifts the conversation from, are you built for my business, to, okay, how fast can we get this rolled out?
Which leads us perfectly into the third and maybe the most dramatic lever. The massive expansion of their sales channels, especially field sales.
The scaling here is pretty astounding. They started the year with basically 0% of US NBA coming from field reps.
I know.
Now it's 12%. And to do that, staffing went from just 42 field reps in June to a target of 150 by the end of the year.
Wow. And that's just the U.S.
Right. Globally, the international sales teams are seeing NBA growth over 70%. The momentum is huge.
I have to play devil's advocate, though. Scaling a sales team that fast, from 42 to 150 in 6 months, that sounds like a recipe for a quality disaster. How do they not fall apart?
It's a critical question, and the answer goes back to that data discipline. The marginal ROI for this channel is holding steady at around 250%. They are proving the channel is profitable before it's even fully staffed.
So what's the secret sauce that's making those new reps so efficient right out of the gate?
This is where their unique moat, their real advantage, comes into play. It's data targeting using Cash App.
Wait, you mean the consumer Cash App?
Yes. They use proprietary Cash App debit card data at the neighborhood level. They know what 58 million active consumers are spending and where. They can basically map out competitor penetration block by block.
I have to stop you there. That feels like cheating. So a sales rep isn't just wandering down a street. They're being sent to a specific block where Square's data shows a high volume of Cash App users spending money at a competitor.
That is precisely it. They eliminate the guesswork. The cost of customer acquisition plummets because you know there's a high-value target there before the rep even parks the car.
Unbelievable.
And on top of that, over 50% of the inbound leads for this team are coming from partners. Think Cisco reps, telco reps who are already in the building talking about other services.
It's a whole ecosystem feeding them pre-vetted leads.
And the product wins validate it. You hear stories like Blind Tiger, who left for a competitor and then came back voluntarily, or Bluestone Lane, who tested Square against a huge incumbent and rolled it out to 70 locations in just 3 weeks.
Okay, let's talk about the fourth and final lever. This is the longer-term bet, the new channels, and the S-curve opportunity.
The biggest new bet here is on third-party sales. Right now, it's tiny, maybe 1% of US NBA, but the pilot program proves the economics work. About 90% of the deals are at a fixed list price, which means less haggling and more predictable revenue. They've put real leadership in place to scale this channel up aggressively.
And they're banking on this, hitting over 10% of their new business by 2028. That's a huge shift. That's real S-curve growth potential.
It is. It shows they know they need more ways to grow than just their own direct sales force. And internationally, they're doing something similar, investing in direct processing relationships to improve margins and testing new partnerships with local payment providers, starting in Mexico.
So localization combined with efficiency.
That's the name of the game.
So that's the full picture of the turnaround. But to hit that 23% growth rate for the next 3 years, they need some serious, hard-to-copy competitive moats. What are they?
They lay out four, but they really boil down to infrastructure and synergy. Number one is true global reach. Having over half your new business come from international markets is a massive advantage.
Right. Number two is just pure infrastructure scale. All that investment in their own payment architecture.
It gives them scale advantages that smaller players just can't match. Then number three, the real game changer, the Cash App synergy. They aren't just selling a POS system anymore, they're selling an ecosystem.
They can tell a merchant, we don't just help you run your business, we can actually bring our 58 million active consumers to your door.
It completely changes the conversation. It turns payment processing into a loyalty and marketing tool. It's a radically different value proposition.
And the final note.
Profitable, compounding growth. They're very clear that this acceleration is being done with strong profitability, not the growth at any cost model we've seen elsewhere.
So this reacceleration in 2025, it really was driven by disciplined execution, a focus on ROI, expanding field sales with that proprietary data, and doubling down on new channels.
They're showing that the platform was always this capable. It just took a complete overhaul of the go-to-market engine to prove it.
And this leaves us with a final provocative thought for you to chew on. The integration of the consumer side, Cash App, and the merchant side, Square, is their radical advantage. So if their proprietary use of Cash App data can so accurately predict where to send a salesperson, a capability only they possess, what other operational inefficiencies across the entire retail and service industry can be solved simply by merging consumer transaction data with merchant sales strategy?